Good morning and Happy New Year. I hope all of your 2016 is off to a really great start. I'm Nick Stern with Robert L. Stern Financial Services here in South Amherst, Massachusetts. Thank you all for tuning in. Really appreciate it. So, the first video of 2016, I think it's important that I wanted to address one of what we think is some of the larger, more immediate risks out there. In particular, which I'm really going to focus on today in brief, is headline risk. There is a incredible amount of noise, as we would call it, out there where everything that you turn on regarding news, media, social media, the newspaper, magazines, just about every news station is just constantly overrun by the negative. More recently, as I'm sure you're aware, there's been some incredible volatility in the financial markets, and there are plenty of pundits out there calling for this, that, or the other. Generally, they're negative, and it's really tough to see, or challenging, I should say, to see through that noise. And it's important that you do see through that noise, or if you have questions, you talk to your advisor, because that's really what their job is seeing through all the negativity, seeing through all the noise, and putting any of the factual information that comes out into context, and then assessing how that affects you, or in this case, their clients. And some of the biggest mistakes that people tend to make are making knee-jerk and panic reactions, and it's very easy to do that when you are constantly bombarded by negative news. We see headline risks as certainly one of the most impactful in the near term, and it can really create more volatility than what's due. We feel that we're in a period of constant overreaction, and even though the most recent volatility is rather normal, we just haven't seen it in the recent quarters or couple of years as much. But volatility is a normal part of the financial markets. It's just what we feel has changed is the amount of volatility, or the extremeness of the volatility, where a company reports earnings and they either meet or exceed expectations of Wall Street, for example, and it could send the stock way up, down, the same. Typically, if it's up or down, it's usually in some sort of overreaction. So volatility is normal when it comes to financial markets. It's just we've entered into a time period where everything is just so over exaggerated, in our opinion, one way or another. By sheer operation of the financial markets, we're bound to have more volatility. And what we're talking about today is that headline risk, which, we have a study that was done that can show a correlation between viewership and volatility in the market when it comes to a specific news station. And as the negative news increases in the media, or for this particular station, the volatility in the market actually increases as well. So it's interesting, when things are calm, there's less viewership on news, and when things are more volatile, viewership seems to go up. And we would attribute that to a much greater volume of information available, but most of that information, or a majority of that information, in our opinion, is negative or neutral at best. there's not much positive, when in fact, I mean, you probably wouldn't know that the economy is growing at a solid pace according to the numbers, or that unemployment is fairly low, or there's plenty of other positive things going on, but the media or the headline risk really tends to focus on the negative, and we feel that that's because negative news sells a lot better than positive news. So the whole point of 2016's first topic discussion is to see through the negativity, see through the noise, and, like the name of this video, make music out of noise. If you have any questions, please feel free to reach out. There's an email, number, website at the bottom of the screen. There's, of course, no obligation whatsoever. We're here to help. Just before I go, remember to focus on your goals. Remember that if you're in a more longer-term investment account, near-term volatility is painful, but will most likely not have much of an impact on that longer-term money. Regarding when it comes to the more near-term money, of course, there's more of an impact. But again, remember your goals. Remember what that money or investments are for, so that it'll help you not make a knee-jerk or panic reaction, and it'll help you see through that noise. Thanks again for tuning in, and I'll see you in February.